In this week's video, we'll review the latest charts to help us answer the question: are we looking at a bear market, a correction, a pullback, healthy rotation, or are higher highs on the way? Since the S&P 500 bottomed in October of last year, your leaders have been pretty consistent. The tech sector, growth stocks, communication services, a sector in the S&P 500 index, and the S&P 500 index itself, or SPY. And for the most part, every other sector over here has been a laggard. And we can add to that list small caps in the equal weight S&P 500, and down at the bottom, bonds have been lagging, along with the rest of the list. Thus, if we're going to experience a permanent shift in leadership, we logically should be able to compare present-day leaders and the look of their trends and charts to present-day laggards. And we'll do just that to see what we can learn. And we also want to ask and answer two additional questions. Let's assume we're not looking at healthy rotation and we're going to go into either A, a traditional deflationary bear market and recession, or B, something more like what we saw in 2022 or in the 1970s, an inflation-induced bear market. Let's set the stage by looking at the health of the general market. As of the close on Friday, it's difficult to understand the meaning of Friday's session since we had an odd event, a major IT outage globally. But even in that context, chart on your screen dated Friday, July 19th at 1 p.m. Eastern Time, trend on the right side looks relatively healthy when we compare it to this more concerning look in January of 2022. Same basic chart, and in both instances we're looking at the 20-day moving average in blue all the way out to the 250-day moving average in black. Much like the chart of the S&P 500, it's difficult to look at the chart of the equal weight S&P 500, RSP, and see that it's broken above this major base here in a bullish manner and continues to consolidate in what appears to be a healthy manner. And all of that is happening above an upward sloping 250 week in black. The right side of your screen looks a lot more constructive relative to early 2022 here. And if we look at the tech-heavy NASDAQ 100, similar situation. Let's move to the left side of the screen. This is the peaking process in the second half of 2021. The black box and the blue box, they're both 7-month periods. Right side of your screen is a much stronger looking trend relative to the left side of the screen. And if we remove price and focus on the moving averages in isolation, on the left side of your screen, there's a 6-month period during the topping process where the 20-day moving average hits this red line 1, 2, 3 times. It's a sign of a weakening trend. If we go back 6 months in the present day, look how far away the present day 20-day moving average is from the 20-day moving average 6 months ago. Doesn't mean we can't go backwards, but it means the present day trend is much more confident, much more stable from a long-term perspective relative to this rollover look here in 2021 and into January of 2022. And compare and contrast the cluster and the look of the moving averages here in December and January relative to the present day. This really doesn't look anything like this. And if the present day were going to morph into a major topping pattern, most likely that would take some time. And if we look at small caps in isolation, it's difficult to get overly concerned when they broke above what is for the most part a multi-year base. This is 2022, this is 2023, this is 2024, consolidated above this box in a healthy manner, and then broke above this consolidation pattern in recent weeks. All of that is occurring above an upward sloping 250-day moving average in black. Now, having said that, from a leadership perspective, how do we look relative to the permanent shift question? So let's look at the same time period, but this time look at small caps IWM divided by the S&P 500, and you can see thus far there's no change relative to what is a clear and discernible downtrend against small caps and still favoring large cap dominated SPY. Now let's shift over to a weekly chart and look at small caps relative to the previous leaders, XLK. You may remember last week we talked about this period in here, November of 2020, where you can see small caps started to outperform in a significant manner. If we zoom in on that look, you can see at the end of a week on November 13th, 2020, the 10-week moving average in gold had a positive slope for several weeks. It crosses above the 20-week moving average in black. The 20-week turns up. We also have a turning up look in the 30-week moving average in blue. Prices above all three of those moving averages, and it also cleared the 40-week in red. We're above the 40-week this week, but the 10-week really isn't anywhere near crossing the 20-week in black. The slope of the 10-week is still down or flattish for the most part. And in general terms, this is a significant move, a rare move in a short period of time. Regardless of leadership, if we take into account that IWM is very, very close to a base here, which means it has significant upside potential and a lot of potential support below price, which typically means favorable risk-reward ratio. So we've taken another incremental baby step to add to a small position in small caps. And if we're going to increase that small position to a larger position, this chart still needs to improve. And the lower right-hand corner of your screen needs to look more and more like the left side of your screen here. And that absolutely positively may happen. We'll see how it unfolds. Another subtle difference. In early November, if we look backwards into late October here, October 24th, you can see this ratio has been making a series of higher lows for the most part and a series of higher highs. It's not really what we have over here in 2024. Doesn't mean it can't happen, but thus far this still looks like a weaker relative trend compared to early November of 2020. And walking forward from November of 2020, small caps significantly outperformed tech. As we noted in the open, generally, looking back several months relative to the S&P 500 sectors here, there's 11 of them. Only 2 of them, Tech XLK and Communication Services XLC, have been leading in any consistent manner. So if we examine the other 9 sectors of the S&P 500, are they starting to improve in a way that says a permanent shift may be taking place? Or more succinctly, are we looking at healthy rotation or a shift in the primary trends? I'll start with the real estate sector. XLRE in the ETF world, you can see it remains clearly in a relative downtrend on July 19, 2024. So far, this move in the lower right-hand corner of your screen looks like a 100% normal and to be expected counter trend rally that can occur within the context of an existing downtrend. Now let's shift over to financials XLF relative to SPY. This is 2020, 2021, 2022, 2023, and 2024. If you drew a line from this point here in 2021 to the present day, for the most part, you have a downtrend against financials. But this is a complete mess. And if you're a long-term trend follower, for the most part, you'd rather just take the easy way out here. Forget about XLF in this environment and own SPY. It typically outperforms, and it's a lot easier than trying to flip between these two instruments. Most likely, if you try to do that with this spaghetti-like chart, you're going to destroy rather than create value. Pick your battles. And if we focus on the right side of the chart, there's no clear shift telling us that XLF is clearly in a better position from a trend perspective relative to SPY. The same can be said for healthcare. Clearly in a downtrend. Thus far, this looks like a counter trend move within the context of that relative downtrend versus SPY. Before we flip over to the next chart, if we go point to point from January of 2023 to the present day down here, you can see that's a downward sloping trend line. The chart of communication services over the exact same period is an upward sloping trend line. Communication services in this window here, one of the few sectors in the S&P 500 that has shown an ability to outperform recently. However, if you drew a trend line from here to here to here, or you went to a weekly chart, there's a downward sloping 200-week moving average here. So this week we took some profits in XLC, can see this relative trend is waning, and we'll see how it unfolds. Nothing on the chart of XLI Industrials relative to SPY that screams new leadership trend. In isolation, the chart looks fine. Just broke above a long-term base, retested that base here, and then it's moving higher. All of this consolidation here occurring above an upward sloping 250-day moving average in black. So even the chart of a laggard is not particularly concerning. Does this chart, XLY Consumer Discretionary relative to SPY, scream long-term leadership shift? It does not. In the chart of consumer staples relative to the S&P 500, it is also clearly in a downtrend, and that will help us shed some light on this question here. Are we heading into an inflationary bear market similar to 2022? To answer that question, let's come over to the left portion of your screen and see what this ratio did in late 2021, early 2022. There's a clear shift here toward a defensive bias. And when the S&P 500 peaks in very early January, I believe it was January 3rd, 2022, the ratio of defensive consumer staples relative to SPY was already above the entire moving average stack. The 250-day moving average in black was flattening out and eventually turns up. In the present day, the ratio just recently made a new 52-week low, and it trades below a downward sloping 250-day moving average in black. This really doesn't look anything like this shift in here, and it's noteworthy. This shift began several weeks before the S&P 500 peaked. This is the look of the ratio here. Here's the peak in the S&P 500. Do materials look like they're about to step forward and take a leadership role? The answer is no. Materials XLB relative to SPY clearly in a downtrend. The last thing it did was make a new 52-week low. Similar to the defensive XLP SPY ratio that we just looked at, very similar message from XLU SPY. The defensive shift is easy to see here in late 2021, early 2022. And notice in January of 2022, the ratio was trading above the 250-day moving average in black, and it was starting to flatten out. It's not what we have in July of 2024. The ratio remains below a downward sloping 250-day moving average in black, and the ratio really hasn't done anything yet to indicate it's breaking this trend line. If we move out here and these moving averages turn up, and it's fair to say that this tight clustering look in here is similar to the turn here. If we get out here, we'll learn something. Right now, this looks like a counter trend move within the context of an existing downtrend. Energy relative to the S&P 500 flipped from outperforming to underperforming. This is 2023. This is 2024. The ratio trades below a downward sloping 250-day moving average in black. Having said that, XLE in isolation looks pretty good. It is trading above an upward sloping 250-day moving average in black. And that brings us to the other ETF or sector ETF that's been outperforming, XLK, the tech sector. And it is unquestionably starting to look a little more vulnerable in here. And it's fair to say that this volatility in here in recent weeks is telling us to pay closer attention. That's one of the reasons why we peeled off some profits in XLK. We peeled off a little bit of profit in SMH, the semiconductor ETF, and in XLC, communication services. Nothing radical, but at some point you have to start a migration process. This relative chart still in an uptrend. The last thing that it did was make a new 52-week high, but this needs to be watched more closely. Now, having said that, we also need to take into consideration that if we look at XLK in isolation, it unquestionably remains firmly in an uptrend. And the right side of your screen really doesn't look anything like early January 2022. But if this look up here in isolation starts to morph into something more like this, then we'll learn something about increasing bearish probabilities. Right now, this looks like a position that's got extended from this base, and maybe it needs to come back and retest this base. All of this is occurring well above an upward sloping 250-day moving average in black. That's significantly different from the look in here in 2022. During Friday's session on July 19th, XLK was trading above an upward sloping 50-day moving average. This is what the 50-day moving average looked like in January of 2022. It rolled over and turned down and went through the moving average stack. And yes, there's been some relative improvement in the equal weight S&P 500 RSP relative to SPY, and we did add to our very small position in RSP this week, and we did so in an incremental and relatively small fashion in terms of the percentage of our portfolio, and you can see why. RSP is clearly in a downtrend relative to SPY. If the chart on the right side of your screen starts to morph into something more like this, then we would be open to increasing our exposure. The size of the move that we made this week is based on the look of this chart, and the small incremental add in small caps is based on the look of this chart. We'll see how both charts evolve in the coming days, weeks, and months. This is also good to keep in mind. During the 2022 bear market, tech XLK in here significantly underperformed SPY. Common sense would tell us that since SPY is a capitalization weighted index, common sense would tell us it's not surprising that the equal weighted S&P 500 index outperformed SPY when tech was underperforming. So concerns about tech would increase if the look of RSP relative to SPY on the right side of your screen started to morph into something more like late 2021, early 2022. That may happen very, very soon. Hasn't happened in any meaningful way yet. The slope and the ratio over here, quite a bit different relative to the slope over here. How about if we leave the S&P 500 sectors? SCHG growth relative to SPY recently broke out of a consolidation pattern here that dates back to late 2020. You can make an argument that this looks like a bullish breakout above this level here. What once acted as resistance may now act as support. What once acted as resistance may now act as support in this region here. Thus far, this consolidation in here in recent weeks in the SCHG-SPY ratio is occurring well above an upward sloping 250-day moving average in black and above the black box. Keep in mind that retest and or markets like to overshoot, so a successful retest could come all the way back into this area here and test this basing pattern in here. Not a prediction in any shape, form, or fashion. You just don't want to get shaken out of a market because of a short-term overshoot. If this ratio moves into this white space here, the longer it stays there, the more concerning it would become. Chart dated July 19th. Also noteworthy, when the S&P 500 peaked, the look of this ratio here in January of 2022 is significantly different relative to the look in July of 2024. And the slope of the 250-day moving average in the present day, significantly different relative to Q1 and into mid-year 2022. What does it look like when investors just dump stocks and would prefer to be in cash? SCHG relative to 1 to 3 month T-bills. If the present day chart, right side of your screen, starts to morph into something like January of 2022, concerns would increase. It's just not what we have in the present day. Very similar situation. Are people running for the exits and running for safe havens like 1 to 3 month T-bills? Not based on the look of the chart in July of 2024. This really doesn't look anything like this in here. Obviously, things can change quickly, and we're not making any assumptions about what this chart over here on the right side of your screen is going to look like next week, in 3 weeks, 3 months, or 3 years. We'll take it day by day with an open mind about a wide range of outcomes, from wildly bullish to wildly bearish. If the 20-day moving average in the present day slashes through the stack like this, concerns would increase. It may happen very, very soon. Hasn't happened yet. How about the thesis that 2024 is going to evolve into something like the peaking process in the year 2000 and or late 2007, early 2008, the financial crisis bear market? Both of those were traditional deflationary bear markets. And there's a reason why we want to be concerned about deflationary bear markets, because they can be very, very painful. The S&P 500 in the financial crisis lost approximately 50% of its value. How about the theory that you shouldn't be happy about Fed rate cuts because the Fed is too late, and once the Fed starts cutting rates, the market's going to peak? That's basically what happened in this window here. The Fed tried to cut rates during the financial crisis, and the market continued to fall. And in that environment, with the Fed cutting rates on a relative basis, bonds were a great place to be. And you can see a diversified basket of bonds. AGG absolutely pulverized SPY walking forward from late October of 2007. Thus, in the present day, if market participants were concerned about a deflationary bear market and an economic recession and or a serious recession, we would expect the present day chart to be migrating in this direction. You can see by the time January 1st, 2008 came around, this ratio was above the 20-day moving average all the way out to the 250-day moving average in black. How does the exact same chart look today? Better, worse, or about the same? This is the look that we really would want to avoid. And you can see July 2024 on the right side of your screen really doesn't look anything like late 2007, early 2008. Thus, market participants in the present day are not anticipating that we're in a situation where the Fed is late to the party and they're going to cut rates and it's going to be too late. We're going to go into a recession and a horrible bear market. Because if that were true, you would want to own bonds. They would benefit from multiple rate cuts. You would not want to own stocks because earnings would get hit. And that's why this ratio started to rise in 2008. Bonds were much more attractive in that type of environment relative to stocks. Right now, this ratio is hovering right around a 52-week low. And the last several months really don't look anything like this period in here. So market participants don't seem to be concerned about a deflationary recession and bear market. Growth stocks just broke out of a multiple year base and thus far are holding that breakout or retesting that breakout. There's no mad rush to load up on defensive XLP relative to SPY as there was in Q4 of 2021 before the 2022 bear market. The strength of the trend in the NASDAQ 100 looks quite a bit better in the present day relative to the period walking forward from August of 2021 into January of 2022. RSP, the equal weight S&P 500, just broke out of a multi-year base and is consolidating above that base in a healthy manner. Interest rate sensitive small caps have done something similar. And the chart of SPY still looks constructive in isolation on July 19th. And the same can be said for the chart of the triple Qs. So most likely, any counter trend move has probably been healthy rotation, and the markets have moved a long way, so we shouldn't be surprised if there's a give back or there's a period of sideways movement and volatility, which is probably a higher probability than a 10% correction. And based on everything that we've looked at, a devastating bear market does not appear to be on the horizon. The charts that we just reviewed back that up, and so do these objective model scores on July 19th. This retest look here and these wild swings up here are helpful because we all know the only way that we can use all of this effectively is if we had it next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.